This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, I left you at the end of the previous session there to have a go at what you see in front of you here, example 2, which hopefully you both performed and reviewed. But very quickly, what we've been asked to do is to work out just the property income assessment here for our tax year 18-19. So we need the rental income received less the allowable expenses paid during the tax year. So we're told let out an annual rent of £9,600. So whereas with previous example, where it was only let out part way through the tax year, we've got a full year's worth of rent that should have come in here, payable monthly in advance. So we'd expect to see the entire £9,600. But of course, what transpires down the bottom here is that we had a tenant in from the start of the tax year 18-19, but basically during June 2018, did a runner, as they say there, left the property without having paid the rent due. Sid was unable to trace the defaulting tenant, so that money never came in, but we did manage to let the property from the next month, from the 1st of July. So rather than having 12 months worth of rental, we've only got 11 months worth of rental. So of that 9,600, just 11/12 would equal the amount received there. Having got the rental income received, what about the allowable expenses paid? Well, we've got payments here. Here's the pay dates. May 18, well, that's in the tax year. But look what it is, construction of a garage replacing the carport. That's an improvement. A carport is just a cover across the side of the house there. Construction of a garage. So in which case, that is improvement, that is capital expenditure, that is not allowable revenue. But when the property is sold, of course, that's when, in addition to any other capital costs incurred in acquiring and improving that property, you can also deduct from the proceeds the £2,000 construction cost of the garage. But it's not a revenue, it's a capital expense, so we don't deduct it here. Insurance for the year. Paid June 18, £480. Again, we've given you information there about what it was for the previous year through to the 30th of June of 18. It doesn't matter, we don't use now an accruals basis. That's what you would have used back in 17-18. It's what you'd still use if, of course, the taxpayer elected to have the accruals basis in use. But unless you're told that, which you probably won't be, then you've got to work on a paid and received basis for cash, a cash basis. So there's the amount paid, 480, June 18. So that one, allowable. Come back to the January 19 one in a moment. May 19 there. Got November 18. I'm skipping one there. November 18, drain clearance, paid in November 18. That's a perfectly allowable revenue repair expense and therefore is allowable. Again, I'll come back to that one in a moment. It's the trickier one. But this one, without even looking at what it was, May 2019, that's to be dealt with in the 1920 tax year, whereas redecoration work, it will of course be an allowable expense. It doesn't matter now when the work happened to have been completed. We're not using the accruals basis, we're using the cash basis. So that then will not be deductible. We bought this new cooker with integrated microwave oven, you'll be pleased to hear, replacing a cooker, so that's not the same product, sold for £50. So off the old cooker, for which there'd have been the original one, if it were the original, there'd be no allowability as regards that initial cost. But we do get now replacement furniture relief. A replacement cooker, rather than this integrated cooker and microwave here, a replacement cooker, a like for like, that would have cost £300. So that's the basis of the allowable cost. But what do we reduce it by? Any amount received on the old item there, the old cooker. So we've got 300 minus 50, that'll be £250. So you put those expenses paid together, deduct them from the property income received, and all being well, you came out with an answer that looked something like that one. In fact, exactly like that one, I would have hoped there. So again, hopefully all okay with that. Back to the notes and on to pastures new. What we've assumed at the moment, of course, is that any rental income received will be bigger than the allowable expenses paid, and in most situations that you'll see in the exam, that will be the case. But of course, you might have a year where you incur rather more expenses than you'd anticipated and may have rather less rental income than you would have wanted, in which case it may end up that the expenses outweigh the rental income and therefore you incur a loss. Or whenever we make losses, you don't put a bracketed, a negative figure into your income tax computation. Instead, there is nothing to assess, but there is a loss. If they, HMRC, if they are going to assess us on profits when rental income is bigger than expenses, when it's the other way around and expenses are bigger than income, then they've got to give us relief for the losses sustained. It's a very simple rule. But if our total expenses do indeed exceed rental income, so we've made a loss, the property income assessment is nil, and that excess property loss is carried forward. Only one thing you can do with it, carry it forward. And what will you set it off against in future tax years? Future property income profits only. Can't go against any other source of income. It will simply go forward against future property income there. What you might have in an exam question is you've got rental income received less allowable expenses paid this year, and you've got a net property income assessment. They also tell you that brought forward at the start of the tax year was a brought forward property income loss. That will then be set off against whatever is this year's assessment. In working out whether or not we had a profit or a loss, a major expense item we said for most people renting out property will not have absolute ownership of that property. In most cases, they will have taken out a mortgage. They'll have taken out a buy-to-let mortgage in order to finance the purchase of the property. And up until and including the 2016-17 tax year, any such finance expenses that they incurred were allowable expenses against the property income. So it would reduce the property income assessment to then include upon the income tax computation. The figure assessable for property income would have been made lower by the full amount of the finance expense incurred. But they changed then from 1718 the tax treatment of that finance expense. And what we're told about here is what we now do. From 2017-18, fundamental change for residential property. Commercial property is unaffected by these rules. As to how tax relief is achieved for such finance expenses incurred in a tax year. So that back in 1718, only 75% of the expense was deductible, and the remaining 25% falling then in 25 percentage points to 0% from 2021. I'll tell you what happens to the other 25% in a moment. But whereas in 1617, 100% of the finance expense that you incurred was an allowable deduction. In 1718, it was only 75% and falling in 25 percentage points from one tax year to another. It's going to be therefore 0% from 2021, but in 1819, it's now 50% of the finance costs will be allowed as an expense deduction against the rental income. Now, clearly what that means is that the property income assessment is bigger as a result. Now, you might think, well, that's not fair. Well, fair doesn't necessarily have anything to do with taxation, remember here. Don't use the F word fair when talking in terms of taxation. But what has happened is that the amount that is not deductible is not lost from relief. It's not lost from the taxation system. But they've defined a very different way by which tax relief will be given for that other, the 1819 tax year, that remaining, that other 50% of that finance expense. And it will now achieve tax relief for the taxpayer, not as an expense, but as a tax reduction. We'll call it interest relief. It will show as a tax reduction in computing the tax liability of the taxpayer. The relief, however, will only be given at the basic rate of 20%. So what's going to happen is, instead of allowing all of the finance expense as an expense figure in the 1819 tax year, only half of it will be allowed as a deduction against income. The remaining half, at 20% basic rate of income tax, will then be a tax credit to be deducted after calculating tax at basic rate, higher rate, additional rate, whatever you might be there. You'll then take away this interest relief, this tax reduction, this tax reducer, that will be that remaining 50% of the finance expense at 20% basic rate relief. You might say, what difference does that make? Why does it matter? We'll explain that in just a few minutes' time. It says, this change will therefore have no overall effect on the tax liability of a basic rate taxpayer, but will increase the tax liability of a higher rate or additional rate taxpayer. Now again, we'll explain that. But what's going to happen therefore, as an example, in 1819, if you were told that you'd incurred your mortgage interest, that mortgage, your loan on a property, mortgage interest expense of £4,000 was paid. In 1819, only 50%, £2,000 of that will be shown as an allowable expense to set against the property income received. That will reduce your property income by £2,000 rather than £4,000. The remaining 50% of that expense, £2,000, will then achieve tax relief as a tax reduction at the basic rate of 20%. So that will reduce the tax liability by, well, £2,000 at 20% is £400. So having calculated, doing your normal tax calculation on your normal taxable income, non-savings, savings, dividend, basic rate, higher rate, additional rate, having got that figure of tax, using the property income assessment where we've only allowed 50% of the finance expense, having got that assessment, got that tax, before you then denote that total as tax liability, you take a deduction out. Here, that deduction, £400. It means that if you are a higher or additional rate taxpayer, you're only now going to get relief in this way at 20% instead of at 40% or 45% if you were a higher rate or an additional rate taxpayer. Now we'll illustrate and explain that particular point in the example that we're about to do here. Let me explain to you, though, that the examiner is not going to ask you to explain the rationale behind it. He's going to ask you to deal with it. How do you now deal with that? Well, let's see what we do. Dora House has employment income of £60,000 in our 2018-19 tax year. Rental income received £10,000. She paid maintenance expenditure on the property in 1819 of £800 and mortgage interest charges of £6,000. Again, compute the 1819 income tax liability of Dora. So what we can see, there are two sources of non-savings income. Our employment income there, that's non-savings, and then rental, our property income, is also non-savings. We know what the employment income is, it's £60,000. We've then got to work out what our rental income received will be. Net rental income, I should say. The gross rental income received was £10,000, from which we're clearly going to deduct £800. Maintenance expenditure, perfectly allowable, revenue expense paid in the tax year, we're told, £800. That will be deducted from your £10,000 rental income received. But in 1819 tax year, only 50% of that £6,000, i.e. £3,000, will be allowed as a finance expense against the income received. So instead of deducting from this £10,000 the full £6,000, which the original system would have done, in 1819, only £3,000 will therefore be deducted. So clearly the property income assessment is going to be bigger by comparison to what it was years ago by that differential of £3,000. And as we can see, 60 plus whatever the property income figure is there, we're going to be a higher rate taxpayer. DORA is a higher rate taxpayer. So that means there's more income to be taxed at 40% as a result of the disallowance of the other £3,000 of the £6,000 expense incurred. We will give some relief for that £3,000, but not giving it relief at our rate of tax, a higher rate taxpayer, but giving relief instead at the basic rate of only 20%. Let's have a little look, therefore, at the answer as to how this would appear in terms of our workings and our computation. Moving through. The property income assessment, we agree. Rental income received, 10,000. We agree. Only 50% of the mortgage interest in 1819 is allowable, 3,000. The maintenance costs are perfectly allowable revenue expense, deducted. So for this tax year, the property income assessment is £6,200. Add that into your employment income to give you total and what is also your net income. No problem at that level of income with the personal allowance, it's fully deducted. Check out the numbers here, make sure I haven't made any computational errors, but we take it away and that should then equal taxable income of just over 54,000, 54,350 as you see there. All of that income is non-savings. You can see here that I haven't bothered with any analysis columns here. Again, what you'd be looking at would be probably an objective testing exercise here, though quite a lot for 2 marks. An objective testing exercise, so there's no marks for workings, as it were. What's our basic rate band? 34,500. Basic rate 20%. There's the first figure of tax. 54,350 minus 34,500 equals 19,850, I hope, which is at 40%. Get that figure of tax. You've got what would then have ordinarily been your income tax liability. But now we get this tax reduction, this interest relief, where we take the other 50% of the £6,000 finance expense incurred, i.e. the other £3,000, and give relief for it at the basic rate of income tax, some 20%. So that is a £600 reduction in our tax, creating an overall income tax liability of £14,240. Now again, the question just asks you for, what's the income tax liability? It doesn't want a justification of that. It doesn't want the rationale behind the new system of dealing with finance expense. It doesn't want a comparison or explanation of what that would be like in previous years or in future years. You just do it, as the advert says. Just to explain, though, what's going on, we know Dora is a higher rate taxpayer. She's going to incur, as a result of the changes in the treatment from once being an allowable expense to now only for 1819 being half allowable expense, half tax reducer, she's going to be facing an additional tax charge, an increase in her tax of £600 as a result of the change in that tax treatment. Look at what happens. The property income assessment is higher by £3,000. If we've been allowed to deduct the full £6,000 finance expense as once we were, it wouldn't be a problem. Our expense, £3,000 bigger, our net assessment, £3,000 lower. So our income would be £3,000 lower, taxable income figure, than it's currently showing. That, therefore, increases our taxable income to be taxed at 40% by that same £3,000. So it increases the tax charge by £1,200. We've got an extra £3,000 worth of income, taxable income, which therefore is taxed at a marginal rate of 40%. Initially, we show a tax increase of £1,200. What we've got then is interest relief of only £600. So the tax gone up by £1,200. It is then reduced by the interest relief of £600, which equals a net increase and additional tax charge of £600. That's where that figure comes from there. Now again, you shouldn't have to explain it, but if you understand what's going on here, then maybe it makes it easier for you to understand how then to answer this. But at the end of the day, tax is a doing exercise. You're not going to be asked why. Taxation is not a why question. It's an is situation. People have made up rules. Those rules may not sound sensible to you. They may not be in part understandable by you, but so that's not the case. You just do it. We don't say why, it is. Different people at a different point in time could have a different basis of dealing with it. Look what's happened here. We used to use an accruals basis. They, the government, have now changed their mind, and they now use a cash basis there. Things change, different people have different perspectives. We learn the rules and we apply them. But there you can see, as compared with what was happening before, we're seeing an increase in tax charge of £600. And it's only going to get worse. It's going to get worse because by 2021, there will be absolutely no finance expense. In 2021, 0% of the £6,000 mortgage interest will be allowable. And the whole amount is given as a tax reducer in terms of computing your income tax charge. So your income tax charge will increase by £6,000 extra assessment at 40% equals £2,400, because DORA, as we know, is a higher rate taxpayer. But that's the downside. The upside is we do get a tax reducer, but that same £6,000 is only given relief at 20%. The lack of availability of the deduction against income created an extra income figure taxed at 40%, replaced by a tax reduction on the same figure at only 20%. That will be £1,200, therefore an increase in tax liability overall of £1,200. Up by 2,400, down by 12, increase of 1,200. The problem arising here is only arising because DORA is a higher rate taxpayer. Going back to the situation in 1819, if DORA was only a basic rate taxpayer, then what would happen? 50% of the expense was allowed, 50% of the expense was disallowed. So, increase in taxable income, as we've already said, of £3,000. That would then only be taxed at a marginal basic rate of 20%. So that's a tax charge of £600. How much is our tax reduction? It is also £600, £3,000 at 20%. So the movement between the property income assessment and the tax reduction is such that the income assessment has gone up, creating an extra tax charge to begin with of £600, but is matched by the self-same £600 tax credit, tax reduction there. So basic rate taxpayers are unaffected. This legislation was not targeted at the basic rate taxpayer. The basic rate taxpayer with a little bit of property income, they were not the ones being targeted. The ones being targeted were the ones who had got basically higher rate taxable income, maybe even additional rate taxable income, and it was being funded, a lot of that property income, by huge amounts of debt upon which large amounts of interest were being paid. They are the people who are being targeted here. Now, all you've got to do is learn the system. That's it. End of story. Okay. Going back to our notes. Next issue to look at, something called furnished holiday lettings. Before we deal with this, I'll give you a moment just to have a little look back through that important issue of finance expense. Again, do pause at this particular point in time, go back through our example, go back through those notes. It's a very likely area for involvement in exam questions. Again, especially now, as we've got such a wider coverage of the syllabus with the advent of objective testing questions rather than just written questions that would cover one main area. They're now able to cover lots of individual areas within that section A of your paper. Okay, take a little pause now. Okay, well, a bit of a learning exercise now, which you'll probably actually refer to later in your studies, in all honesty. But it's about this section called Furnished Holiday Lettings. Now, we're used to the idea of property income being assessed on a received basis, rental received less allowable expenses paid. We've seen specific issues there, and probably the most examinable part of all of this as regards the allowability and tax treatment of finance expenses. Those particular types of assessments and issues that we have seen have dealt with your normal property, whereby you're letting it out for a period of time, usually an extended period of time, months if not years there, to a particular tenant. But there has now been brought in sort of more recent years, rules that pertain to a very special type of property income. And that's, as you see here, furnished holiday lettings. So the idea now is, rather than having one tenant in there for an extended period of time, we're going to see, as you would with a holiday, short-term lets, maybe at max 2 weeks, 3 weeks, something like that, often just a matter of days. We're getting into the Airbnb territory here, aren't we? So in terms of these furnished holiday lettings, there is some preferential and some not so preferential tax treatment that happens. If you are providing this service of a furnished holiday let, there's rather more work for you to do. You don't just sign a lease agreement with a tenant for 12 months and then just watch the money come in and go around and check the property every now and again to make sure that it's okay, that they haven't wrecked the place indeed there. Now, you might have, again, these tenants, in inverted commas, coming in for 2 or 3 nights. Every time new tenants come in, go out, you've got to go in, do work. You've got to clean the property up, prepare it for the next guests to come in there. And what that is doing is taking on rather more the idea of a trade. We talk about property business income. And what we got here, therefore, these special rules that now apply, not hugely different, by the way. The letting is treated as if it were a trade. This means, though, again, we're going to tax it as income, property income from a UK property business. Some of the provisions which apply to actual trades, your normal trading issues that you'll see in the next chapter and beyond, dealing with trading profits, some of the things that we see there will also apply now, but purely for this type of rental property, furnished holiday lettings. Okay, what are they? Now, we haven't dealt with these yet, so it's, again, not something for you to worry about, just an awareness at this stage. You'll come back to what are these learning exercises like this. It's a list of rules that have to be learnt and maybe regurgitated in the exam there, or on an objective testing question identified in an exam there. It's not a doing exercise as such. We've still got exactly the same issues to deal with. What's the rental income received? What are the allowable expenses paid out? All of that is the same. But what we've also got here is that in relation to furniture and furnishings, where we had normal furnished lettings, of course, we had that replacement furniture relief. But now we don't have that. What we have here is capital allowances. Now, capital allowances, we have a very big chapter, and a really important chapter, chapter 5, coming up after we've been introduced to trades and trading income in chapter 4. And what it does is represent the way in which HMRC give taxation relief to capital expenditure incurred there on what they would refer to in chapter 5 as qualifying plant and machinery. And what happens is that the furniture here is looked upon as that in the context of this furnished holiday letting trade, as plant and machinery. Therefore, we get capital allowances. Now, what that does is to define when you buy plant and machinery, what tax relief do you get? Well, what we'll discover in chapter 5 when we come to it is that basically, and certainly here in this context, when you buy furniture and furnishings for the furnished holiday let, you will get a capital allowance which will basically give you 100% tax relief in the tax year in which you incur that expenditure. So that, therefore, is going to give immediate and full relief for the capital expenditure against your income. That, as I say, is dealt with in chapter 5. In Chapter 10, we see pensions. Now, we've seen stuff already, a little bit anyway, to do with pensions, most specifically personal pension contributions. And we've seen how it is that tax relief is achieved, not through presentation of a personal pension contribution as a deduction on the income tax computation in deriving taxable income, because we don't. It is not deducted there. Instead, we saw how we got basic rate relief at source. You paid £8,000 in the tax year into your pension fund, and it got credited with £10,000. Your £8,000 plus £2,000 of tax that had been suffered by you, paid over to HMRC, paid back by HMRC into your pension fund. And then, if you were a higher rate or moving even higher to additional rate, you got the extra relief there by extension of the higher rate bands, extension of the additional rate band by the gross amount of that personal pension contribution. So tax relief was received in that way. So clearly anything that gives you tax relief is very good news. But it's not carte blanche, as you'll discover in terms of Chapter 10, for you to just put any amount of payments into your pension fund and gain tax relief. There are limitations, there are caps placed upon how much pension contribution in any one tax year will achieve tax relief. And the first such limitation that you'll see when we come to Chapter 10, don't worry now, is about your relevant earnings. And relevant earnings will be the basis of allowability in relation to the amount of pension contribution you put in. And your relevant earnings are basically your earned income, employment income, or as we've started to refer to here, trading income. Well, in addition to those two, if you've got profits from furnished holiday lettings, then that too, that net income, that will also rank as being relevant earnings, allowing you there the capacity at least to make bigger contributions into your pension fund and, as we wish to, achieve tax relief thereon. The final one here is capital gains tax. Now then, we don't yet know about capital gains tax other than a very simple concept. We buy a capital asset. Some years later, we sell that asset for more than the total costs we incurred in acquiring it there. And the profit made is a capital gain, and that capital gain is subject to its own taxation, capital gains tax. But there are certain reliefs that exist as regards certain assets when they are sold. And that's going to be a very important area. We'll see it indeed in Chapter 14, where we get the main reliefs coming through. So capital gains tax. Reliefs, and obviously any relief available to a taxpayer that might diminish the gain in any way that would otherwise be immediately taxable, is good news for the taxpayer. So again, it's a plus point. So capital gains tax, rollover relief, gift relief, and entrepreneurs relief. Now, there's a handful in terms of reliefs there. Hugely important to us in the context of the syllabus, but that awaits us in Chapter 14. But again, a normal property, when sold, a rental property, your normal just basic furnished or unfurnished property there, that when that is sold, any capital gain will be fully taxable. What we'll have here is when a furnished holiday letting property is sold, then reliefs may be available. And those reliefs may allow you to defer the gain or indeed diminish the amount of tax charge that is going to be levied thereon by applying a lower tax rate. All of this will make sense after Chapter 14. But again, it's good news. So that's the plus side there. Now, the profit or loss computed for tax years, again on a cash basis, but a bit of a problem now as regards losses. Losses may only be carried forward against future profits from furnished holiday lettings. So we've got to keep as our property income this bit separate from the other property income, because if there is a loss made in relation to your furnished holiday letting, you can't offset that against profits made on other just normal lettings there. So what we do with it is to carry it forward, and it's got this restricted use only against future profits from furnished holiday lets. That is obviously a restriction in terms of allowing you relief for that loss. Anything that restricts your access to the use of a loss is bad news. So that's the downside of this. Overall, on balance, obviously when you go into such a furnished holiday letting business, you hope you're not going to make losses. So hopefully that is a moot point there. So there are definite advantages to be gained. And that's why in the next bit, not something for you to worry about now, but rather closer to the exam, because this is not a doing exercise, it's a learning exercise. With the best one in the world, you learn it now. We're going to fill your heads with a whole lot more doing stuff in the chapters to come. Give it a week, give it 2 weeks, certainly give it the time from now to your exam. You're probably going to forget that. So in which case, be aware of it now and you learn the rules, the detailed rules. Just like with the admin, you'll be aware of it sooner, but you're only going to have to learn it later, i.e. closer to exam date. So the lettings, first of all, restrictions as to where they are. UK or European Economic Area. Basically the EU plus 3 other countries. They're going to tell you if it's an overseas country, whether that is indeed European Economic Area. Furnished accommodation, obviously, made on a commercial basis. Lettings on a commercial basis with a view to the realisation of profit. That's why you're doing this. Here's the specific conditions. Now, this, as I say, is what you'll be learning at a later point in time. To qualify for the sort of benefits that we itemise there, these are conditions. The accommodation must be available to let for at least 210 days in the tax year. Again, this is supposed to be on a commercial basis with a view to realisation of profits. So that therefore means it can't be just your holiday home that you decide to let out for a few weeks a year. It's got to be available to let for at least 210 days. The accommodation then must actually be let for at least half of that, 105 days there. So there's the first 2 conditions. And we've said it's furnished holiday lets. Holidays, sadly, are relatively short periods of time. I wish they were longer. And again, with this, with stuff like Airbnb, it might be a few nights, it might be a week, might be 2, maybe max 3 weeks. What it isn't is someone living in that property for a very extended period of time, like when you normally let properties on leases of say 6 or 12 months or maybe even longer. So here the final rule: no one individual person occupies the property for more than 31 consecutive days. If one or more persons do or does occupy the property for more than 31 consecutive days, then if that happens, again, one individual person in that property for more than 31 consecutive days, then the number of times that's happened with different individuals during the year, these periods of long letting must not exceed 155 days in the year. So there's a limitation placed there on. Okay, not to be learnt now, but to be learnt closer to exam date. Bit more interesting in terms of we can do some calculations on this. Up until this point in time, we've made an assumption, and that is that the property being let out is not the property that you live in. It's a separate property bought with a purpose of letting there. That's why you bought it, not to live in it, but to let it out, to basically run it as a property business and hopefully make a profit thereon. But what happens now is we see that maybe individuals let out a room or rooms within their own property, the one that they live in, their private main residence. And because of that, there are special, more beneficial rules that will apply in this circumstance. So if an individual lets out a room or rooms, obviously furnished, in his or her main residence, again, of course, as living accommodation, then gross rents up to £7,500 per annum are exempt. And this exemption is known as rent-a-room relief. Now that's not bad, is it? That if you are willing to take in what we call a lodger there, someone to come and live in your house with you in your property, they've got their own rooms, access to various other rooms, whatever. But if they rent out a room or rooms in your property, then you could have gross rental income of up to £7,500 a year, and that would be exempt. Any profit made thereon would be exempted. Not bad. The exemption may be ignored. Now you think, why would the taxpayer want to ignore an exemption? Surely exemptions are good news. Well, not always. The exemption may be ignored if the taxpayer wants to generate a loss where expenses exceed income. The idea of exemptions, and we'll see more of these as we go through, is an exemption is great where it exempts what would have been a profit or what would have been a capital gain. Something that removes chargeability to tax as an exemption is clearly good news. But if they're going to exempt profits and gains, it means equally we're going to exempt losses. So if you make a loss and that is exempt, then you're going to get no relief for that loss. Therefore, again, generosity on part of HMRC, they are allowing you here to ignore this exemption. You can elect to ignore that election. And why would you do it? Basically, where expenses exceed income or where your actual expenses exceed £7,500. What we've done here with rent-a-room relief is just to say gross rents up to £7,500 per annum there are exempt. Go over that, we're talking about it being taxable. So what happens? If you go down the rent-a-room route, then if gross rents exceed £7,500 per annum, again, the taxpayer may choose to assess as follows. What would your ordinary calculation do? It picks up your gross rental, takes out your expenses, however many of those there may be, and you get your property income assessment. As we've always done in this chapter, the rental income received less the allowable expenses paid. The alternative calculation that we can use here is applying the rent-a-room relief, whereby whatever was your gross rent, no deduction in relation to expenses, but we simply deduct the rent-a-room relief of £7,500, and that gives rise to your property income assessment. So, what have we got as rules here? If your income is less than £7,500, then that is exempt, and that rent-a-room relief will apply automatically. You are exempt if your gross rentals do not exceed £7,500. However, if those gross rentals don't exceed £7,500, you can disapply this rule. You can say, I don't want rent-a-room. And why would you do that? Because maybe you've got rental income of £4,000 and expenses paid that year of £5,000. With rental income of £4,000, then that's exempt under the rent-a-room relief rules. But if you apply the normal rule, you do away with rent-a-room relief. Again, in this situation where expenses exceed income, I've got income of £4,000, I've got expenses of £5,000. That would allow me to generate a loss of £1,000. And even if I couldn't use that loss this year, I could use it in future years to reduce what might otherwise have been assessable property income. So that's good news. If your gross rental goes over £7,500, then you, to begin with, would just revert back to the normal. Here's your ordinary calculation, as we call it there. Your gross rental less your expenses incurred there. Rental income received, expenses paid. Normal calculation. However, if you wish, you can go the alternative election here for the rent-a-room relief to apply as a deduction against that gross rental. So rather than deducting expenses, working out a profit, you would simply be assessed on the income in excess of that £7,500 limit. Let's see the situation in which that would be worthwhile with our little example here. And the admin side, the election must be made for 2018-19, our tax year, by the 31st of January 21. In admin terms, that we may have mentioned in passing as we've gone through, but you'll see more in the admin chapter 15. Basically, the tax return has to be submitted by a latest date, the 31st of January following the end of the tax year. So for 2018-19, you've got to submit your tax return, pay your tax by the 31st of January 2020. So what they're basically saying here is you've got another year after that to make your mind up whether or not you want to revoke that normal rule and adopt the rent-a-room relief. So let's see what we've got here with example 4. Barbara rents a room in a main residence. Gross rents are £650 per month and expenses amount to £1,200 in 2018-19. Calculate Barbara's property income assessment for this year. Well, the due date, we know about that. It's up there for that tax year. Gross rents £650 per month. Right, get your calculators out. 12 times 650 there. Does that take us over £7,500? Yes, it does. Just. 12 times 650, we'll check on the answer in a minute, but I think that's going to be £7,800. It's over 7.5. So the normal rule would say, pick up your rental income. That's going to be 7,800. We'll check that number in a moment. Less your expenses incurred, and that would be your assessment. There you can see that would be £6,600. But if you were to instead then go with this alternative calculation, you elect for it using the rent-a-room relief figure of £7,500. You take your gross rent 7,800 and now deduct 7,500 rather than the actual expenses. So in this situation, if your actual expenses as here are lower than that rent-a-room relief of 7,500, then this calculation is going to be worthwhile. Let's just have a little look at that in terms of our answer in the back. There's our ordinary calculation. Rental income received, less expenses paid. There is your property income assessment. But here, and sensibly you will make this election here, the alternative calculation using rent-a-room relief, same gross rental, but you simply deduct a standard 7,500, the rent-a-room relief. Clearly that brings you down to a £300 assessment. Well, that's rather better than £6,600. Therefore, as gross rents have exceeded 7.5, there they are. Barbara must elect for the rent-a-room relief to apply if she wants it. She will want this relief and then make it by the relevant due date. Now again, most taxpayers here, like Barbara, would not be waiting around until the 31st of January 2021 to do this. They will have sorted their taxation affairs out by the 31st of January following the end of the tax year, when their tax return must be submitted, their tax must be paid, and therefore they'll have made that claim by that point in time. But you're allowed up to that later point in time. If you didn't realise, you didn't know the rule, you can come back, revisit, and make the election for our 18-19 tax year by that date in 2021. Okay. Check through what we've done so far, because where we will be going next in terms of our studies, still sticking with property income, but looking at something very different that we introduced at the beginning indeed of this particular chapter, what would now be a one-off premium that is received when you as a lessor grant a lease, a short-term lease, we'll define that again in this note next time, on a property. Usually in these circumstances will be a business property, and you're granting what is a, in inverted commas, longer lease, but it's still a short lease. There you can see 50 years or less, that's still a long time, but that defines a short lease there. And in this circumstance, special rules apply that are going to impact both on the assessment of that premium on the lessor, and as the lessee is in business using commercial building within their business, what tax relief that they may be able to gain in relation to that payment made. That's what we look at, and that will see us through on this chapter next time.